Hello everybody, my name is Belinda and today I'm going to talk you through some of the basics of interest withholding tax. This is the first of 3 videos. I'll also provide an overview of royalty withholding tax, dividend withholding tax and foreign resident insurance tax in some subsequent videos. But I'll begin today with interest withholding tax. Under Australian law, interest withholding tax is payable where an Australian resident entity pays interest to a non-resident. Withholding tax is also payable by a non-resident borrower who carries on business in Australia at or through a permanent establishment in Australia. There are other cases as well where interest withholding tax can be payable, such as interest paid by an Australian debtor to an offshore supplier. There are also several exemptions to interest withholding tax, such as those on certain public issues of debt interests. There is an obligation to withhold and remit to the ATO on interest paid where either the payee has an address outside of Australia according to any record that is in the payer's possession, or the payer is authorised to pay the interest at a place outside of Australia. It can be to any non-resident entity. The receiving party does not necessarily need to be related to the paying entity. An amount will be interest where it's paid in respect of a debt interest or it's in the nature of interest. So that is an amount that's related to the time cost of money. While there are specific rules in Australia's legislation which constitute what is and isn't a debt interest, generally where there's a non-contingent obligation to pay the amount borrowed back, then a debt interest will be in place. Care should also be taken of the ATO's position in Taxation Determination 2019-10, where it takes the view that interest-free loans to an Australian resident or discretionary interest loans can be recharacterised under Australia's transfer pricing provisions to be interest-bearing. In these circumstances, there may be a potential withholding tax liability where, under the arm's length conditions, interest would have been charged on the loan. Interest is considered to be paid when either it is physically paid, becomes payable, or it's dealt with on an entity's behalf. Therefore, for example, if the interest is capitalised to a loan balance, it's offset against an intercompany account or intercompany receivable, a liability to withhold and remit to the ATO arises at that point. To determine whether the liability has crystallised, it's really important to review the actual agreement and the terminology used within it, as that will determine the treatment. There are other instances as well in which withholding tax will apply on interest amounts. So for example, where you have a hire purchase arrangement with a non-resident entity. Where a non-resident operates in Australia through a permanent establishment and the non-resident makes a payment to another non-resident, that is incurred by that non-resident in carrying on its business through the permanent establishment in Australia, interest withholding tax in Australia will apply. So where this occurs, there'll be a question of attribution of the expense to the Australian PE, but care should be taken to ensure that withholding requirements are met. Generally, the rate at which interest withholding tax is imposed is 10%, although this can be reduced where Australia has a double tax agreement in place. Australia's double tax agreement network also provides for some exemptions from interest withholding tax. For example, where the withholding tax is paid to an offshore financial institution, although there are some integrity provisions around that. It's important to ascertain at the outset when you enter into the agreement whether interest withholding tax will be payable, as many loan agreements contain gross-up clauses under which the lender will, in certain circumstances, receive additional amounts, so they receive the same amount as if no withholding tax had been payable. In those cases, the withholding tax is going to add an additional layer of cost, which must be considered by the borrower. Where interest withholding tax is payable and the payer fails to remit the amount to the ATO, interest and penalties may be applied. Penalties are doubled for taxpayers which are significant global entities. And in addition to that, no deduction will be available for the payment of the interest until the withholding tax has been paid to the ATO. Please note that just because a taxpayer doesn't claim a deduction, that doesn't mean that there's no withholding tax liability. The interest withholding tax, it must still be paid, and interest and penalties will continue to accrue until it is paid. Once paid, the deduction is then available to be taken, subject to other provisions such as the thin capitalisation provisions. Finally, for all entities which pay interest to a non-resident annual withholding report must be lodged with the ATO. These reports cover the period 1 July to 30 June regardless of whether the paying entity has a substituted accounting period. The report must be lodged with the ATO by the 31st of October each year and includes not only interest payments but also withholding on dividends paid to non-residents as well as royalties. If you require any additional information in relation to interest withholding tax or any withholding taxes in general, please contact your RSM advisor. Yours in tax, Belinda.